My name is Jake, welcome to the channel. In today's video, I'm going to share with you why I am not worried about inflation. I'm going to talk about some of the things that I'm thinking about when I'm looking at my portfolio and when I'm looking down into the future, when I'm investing into the stock market. I'm going to share with you why I'm not concerned. I'm not worried about my portfolio. And I know there's a lot of investors out there that are really scared and concerned about their portfolio, if they should invest in the stock market or not. So in this video, I'm going to share with you some of the things that I'm thinking about. And I know a lot of you that are following the channel, we have kind of that similar approach to how we view investing. A lot of you following the channel, you know that the reason why I invest is so that I can reach financial independence. That's the entire reason. I don't invest for any other reason other than my portfolio is going to buy my freedom. I currently work a 9-to-5 job. My wife works a 9-to-5 job. Our entire purpose around investing is so that we are no longer required to rely on our day job to sustain our lifestyle, our standard of living. So when I look at inflation and when I look at how other people are viewing it and talking about it in the media, it kind of makes me scratch my head and think for a second, well, actually, inflation really isn't a bad thing when you understand it. And so obviously we haven't seen real inflation in a long time. And so in this video, I'm going to talk about 4 things. The first part of the video, I want to talk about understanding your history when it comes to inflation. So I'm going to speak very high level around what we've seen in the past in terms of inflation and why some companies were able to prosper where others weren't in higher inflationary times. Second, I want to talk about inflation in terms of looking into the future and what it could potentially look like going into the next 10 years if we were to have a decade of higher inflation. And then the third thing is I want to talk about a stock, an individual company that I own in my portfolio that I think is kind of a hidden gem that may be really interesting in this new inflationary environment that we may find ourselves in for the foreseeable future. And then last, I'm going to share 10 dividend growth stocks to hedge against inflation. All 10 of these stocks are in my portfolio, and I'm going to share something very unique to maybe not a lot of you maybe thought about. And I'm going to share why these 10 dividend growth stocks are poised to do very well if we do see this higher inflationary environment that everybody keeps talking about. It feels like every news outlet, every media channel is talking about inflation. It's kind of that feeling that there's a lot of fear mongering going on. A lot of people are saying, hey, the market is going to crash. Those clickbaity, thumbnails, titles to articles, whatever. It just feels like there's a lot of noise right now when it comes to the topic of inflation. And to be honest, it doesn't faze me at all. And when I look at my portfolio and I look at my own situation, I just feel like it's just a lot of noise. And for me, when I think about how everybody keeps talking about inflation, it kind of makes me feel a little like this.
Well, Ferguson's not too happy with it, I can tell you that much.
He's beating him like a rented mule.
And the ref's just tuning him out.
Boy, where do you train to take a beating like that?
He said, when's that porch gonna get painted? And that litter box! It's been 3 weeks! 3 weeks! And to think I could have married Don Hoffman. And would it hurt for you to say that you love me once in a while?
Oh my gosh. Oh, I love it. I love it. All right, cool. So I think with inflation, it is to a degree self-fulfilling. If you look at the search term here on Google, when you look at inflation, just here in the United States, we're seeing the highest interest or search volume around inflation in the last 17 years. So to put that into perspective, it really can be a self-fulfilling thing. If we talk about it enough, it will become a reality. And that's, I think, kind of what we're seeing. When we look at the current US inflation rate, and there's many different ways that you can look at inflation. You can look, typically it's through the CPI, the Consumer Price Index. And so I think this has been really the gold standard for measuring inflation, but there's a couple other ways that you can look at it, but let's just keep it very simple. If we just look at the US inflation rate here over the last, 100 years, you can see that we're at a 30-year high. We haven't seen this high of inflation year over year in just about 30 years. And so whenever you hear people talk about inflation in the media, they're usually referring to the 1970s. That's where most people that are alive today can remember when inflation was running hot. And I think we all can agree that nobody has a crystal ball. No one really knows what the future is going to hold for us. I personally have my opinions, but those are really just that. They're just my opinion. I think that we are going to be in a higher inflationary environment for the foreseeable future, but I have no clue if we're going to get up to, 15, 20% here in the coming years. But I would say buckle up, buckaroo, because I think we're here for higher inflation for the foreseeable future, but very important, that's just my opinion. So when looking back in the 1970s, what asset classes were doing really well? So energy stocks obviously did the best during that time period, but I personally, I'm not the biggest fan of investing into energy stocks. I don't own any energy stocks. I don't intend to own any energy stocks. I don't believe that they're the future. Maybe here in the short term, yes, but when I invest, when I look at the investments in my portfolio, I look decades into the future. And so for me, I'm not going to be investing in energy stocks, though there are some really great energy dividend stocks out there. I really like investing into REITs. I invest into physical real estate as a do-it-yourself landlord, but I also invest into publicly traded real estate investment trusts. And I think there's some really, really great ones out there. I also like investing into dividend growth stocks. The dividend growth stocks in this slide here, or in this image, would fit under the S&P 500, but this is the entire index. And during that time period, they actually saw a negative 16% after inflation. So that's really, really bad. So it was a really tough decade when inflation was roaring. But the interesting thing is not all asset classes were affected the same. So to better understand your history when looking at inflation and how the economy and different asset classes performed during inflationary times, let's take a look at it based off of different asset classes. So if we look at the 1970s here in the middle, we can see that US small and mid caps actually performed very well at 11.5%. US large cap equities performed worse at just under 6%. But what's really interesting is international stocks, apart from the US, when it says ex-US, it's including everything except for the United States, actually performed very well with 10%. And then emerging markets with a focus on fixed income performed the best at over 14%. And then you got in here your bonds and your other fixed income and your cash. So in the 1970s, it obviously was different than in the roaring 80s and the 90s, 2000s, and the 2010s, obviously. So it's important to understand every asset class is going to perform different in different micro and macro environments. So when I look back in history and I see the different companies that performed the best in the 1970s, it really sums down to one thing: pricing power. The companies that were able to grow their earnings per share and had pricing power were the companies that actually prospered and became stronger and came out of that time period even stronger. So the type of companies that I think about with pricing power are companies with strong brand recognition. I think of companies like Coca-Cola, like PepsiCo, those type of companies where there's brand awareness, brand loyalty, and they have pricing power. Those are the type of companies that do well in environments where you see higher inflation. So now let's turn the page on the historical lens of looking at inflation to looking forward. Vanguard came out with an asset class based outlook, how each asset class is going to perform over the next 10 years. Yes, 10 years. And so annualized, what's really interesting about this from Vanguard is they have inflation right around 2%. I find that really interesting. So if Vanguard is saying, hey, they predict over the next 10 years, you're going to have an annualized inflation rate of right around 2%, that means we're probably not going to see the same environment that we saw in the 1970s. But I think that there should be a big asterisk here because Vanguard doesn't know. This is just a market outlook, a projection, but it is obviously never a guarantee. But I think it's still interesting because I think the folks over at Vanguard, they're pretty smart. And so let's definitely hear what they have to say. So with US equities, they're projecting an annualized return of anywhere from 2 to 4%. That is horrible. If you look at the last couple of years, we've seen equities here in the US range anywhere from 10 to 20% year over year. So this is a completely different direction that we're headed in over the next 10 years if Vanguard is right. So breaking it down into different segments here, if we look at US value, they're projecting anywhere from a 3 to 5% annualized return. And if you look at growth, this is what's really, really interesting. They're projecting annualized returns for growth anywhere from -1% to 1%. That is absolutely insane. If you look over the last 10 years here, ever since the financial crisis, the sectors that have done the best have been more skewed towards growth. And I think this is going to be really interesting. If Vanguard is right and that growth really stagnates and it's more skewed towards value, in terms of higher returns going forward, I think a lot of new investors are going to get shocked by this. So moving on, with US large caps, they're projecting anywhere from 2 to 4%. With US small cap, 2 to 4%. With real estate, they're projecting anywhere from 2 to 4%. And this is where it gets really interesting. They're projecting global equities. So everything apart from the United States, they're projecting a 5 to 7% annual return over the next 10 years. And then lastly here, with emerging markets, they're projecting anywhere from 4 to 6% annualized returns. This is really interesting because the United States has really dominated in terms of where investors have been parking their money. And it looks like if Vanguard is right, that will be shifting and you will see a rotation out of US equities into ex-US equities. Now, something that I will say, I'm not an expert on this by any means, but something that makes sense to me is you look at the multiples of US equities versus international equities, multiples being the price to earnings. So how expensive a stock is. You're paying a much higher premium for US equities today than you are for international equities. And so going forward, if you see those multiples contract and you see that investors are no longer willing to pay those high premiums for US equities, it only makes sense that international equities are going to see a rotation into them into the next decade. Now, let me give you an example of what I mean by that. So if you go to ETF.com and you look at VTI, VTI is the Vanguard total US stock market. So just US equities, everything from small, mid, and large cap, value, growth, everything. And if you go down here and you scroll down to the portfolio data, this is what's interesting. If you look at the price to earnings ratio, this is a weighted average ratio of prices of a fund's stocks to trailing earnings of the underlying stocks. US equities are trading at a 32 multiple. 32, that is incredibly high. And a big contributor of this is the highest weighted stocks in US equities, in these indexes, are growth stocks. Now, if we compare that to international, so my favorite international ETF is VXUS because it includes everything except for the United States. And so when you look at VXUS and you look at this from the exact same lens, this is looking at 8,000 companies outside of the United States. And when we look at the price to earnings ratio, it's only trading at a 19 multiple. So significantly less than US equities. And so if we do see those multiples contract, I think there's going to be a massive rotation into international stocks. Now, I'm not an expert. I'm just looking at the data. And what the data is telling me is that we're seeing rotations all the time. And I see in the next 10 years, a larger rotation into international equities than what we've seen in the past. So when we really peel back the layers from this outlook from Vanguard, there's a couple of things that stand out to me. US equities, growth, large cap, they're not going to be performing the way that they have over these last 10 years. We're going to see that market rotation that we always see in different cycles in the market. But what I'm noticing is there's going to be a rotation into international equities. And what's really interesting is real estate. So you add that international component with real estate, and that's where I think you may find a lot of great opportunities. So remember when we look back at the 1970s, what asset class was doing really well? REITs. REITs did incredibly well in the 1970s. Vanguard is telling us that international equities are going to perform better. And we know that REITs performed very well during inflationary times in the 1970s. So what could that potentially look like? So let me share some of my thoughts with you. So we know that in the past, REITs historically have done very well in high inflationary times. We're hearing from Vanguard that international equities are going to perform well. So where can we find opportunities in that spectrum? A company that I personally really love is MPW. I've shared an entire video on this company in the past. I'll leave a link in the top right. But something I love about MPW is it's a real estate investment trust focused on healthcare. Healthcare facilities, hospitals, behavioral units, the type of real estate that there will always be a need for. And it's not as cyclical as other segments in real estate. But what I really like about MPW is that they are a US-based company, but they generate a large portion of their revenue outside of the United States. So if we look at their portfolio here, you can see that they're operating in 9 countries. They're focused on general care, acute care hospitals, behavioral health facilities, and inpatient rehabilitation hospitals. If you look at the type of countries that they're in, 60% of their assets are in the United States, just under 20 in the United Kingdom, 6 in Germany, just under 6 in Switzerland. You get the point. So they're in developed countries. They're in an area of real estate where it's a need-based real estate. It's not as cyclical, right? It's not like they're cannabis shops, right? That could be shut down at any time. These are acute hospitals. There's a human need behind it. When I look at the dividend metrics for MPW is trading a little bit higher than its 4-year average dividend yield. So over the last 4 years, if you've averaged in or dollar cost average into it, you've gotten just under a 6% dividend yield. It's currently yielding just over 5%. So it's a little bit pricier than its historical norm. When looking at their 10Q, their quarterly report here, you can see from 2020 to 2021, they've actually increased their international exposure. So in 2020, the revenue that they generated as a whole made up 30% of their overall revenue. In 2021, their total revenue that they generated in this quarter at the end of September was just over 35%. So they're increasing their international exposure and they're growing revenue internationally. So when I look at MPW, I see this as a company that is growing and it's growing its revenue more so internationally than it is here in the United States. And those are two really great things. It's a high quality REIT and it's growing its international exposure. So before we dive into the 10 different dividend stocks that I want to talk about in this video, some other stocks that you could consider that I think are a great place to start. If you're a new dividend investor and you're building out your portfolio and you're looking to do some research, I think a great place to start is with the Dividend Kings. The reason why I like the Dividend Kings is all of the Dividend Kings were in that 1970 high inflationary time. And so if they were able to increase their dividend in the 1970s, I think it may be worth looking into because I think these companies, they have what I was talking about earlier. They have pricing power. So I would highly recommend checking out the Dividend Kings when looking at your portfolio and seeing, okay, which companies or which dividend stocks do I want to prioritize looking into the next 10 years where we don't really necessarily know what inflation is going to be like. I think insulating your portfolio with high quality companies like these will help safeguard your portfolio in a higher inflationary environment. Now I want to share with you my 10 dividend stocks that I believe are a great hedge against inflation. Now, before we dive into these individual companies, I want to reiterate what I've said a few times here in this video. We know that REITs performed very well in the 1970s. The reason why is these are real assets. These are tangible assets. We also heard and we know from Vanguard that their market forecast over the next 10 years is that international equities are going to do better than US equities. So those are the two big things that I want you to think about when you're looking at these 10 different stocks. All 10 of these stocks are in my portfolio. All 10 of these have large operations here in the United States, but one thing that you will notice, all 10 of them have international exposure. All 10 of them have operations outside of the United States. So when we look at this portfolio, It has 10 holdings. The starting dividend yield is 3%. Over the last 5 years, this portfolio, had you invested $100 5 years ago, you would be up 61%. This does not include the reinvesting of dividends, so DRIP. The companies that I have in here, for example, I have a retailer like Walmart. Walmart has a big exposure here in the United States as well as internationally. Walmart is very heavily invested in Canada and in South America. The thing about Walmart that is very interesting that not a lot of people give it credit for is they're growing their e-commerce business. Their e-commerce business is growing almost faster than Amazon. Now, I know that a lot of you are probably going to be raising your eyebrow when you hear that, but Walmart's e-commerce is growing just as fast as Amazon, or just about. Absolutely incredible. Walmart is growing like crazy. The next one here is WPC. WPC is a REIT. It's a real estate investment trust. The reason why I like WPC is for a couple of reasons. They're a diversified REIT. They're in industrials and office buildings. They have operations here in the United States, as well as about a third of their operations are out of Europe. So it's an international REIT. And it's exactly what I was just talking about. If you can marry those two, REITs and international, I think there's going to be a great opportunity. The third one here is Philip Morris. This is a tobacco company. It's a sin stock. I know a lot of you watching this video are not a fan of sin stocks, but I think when you just look at the numbers, when you look at their operation, this is Philip Morris, which is focused on international, not in the United States. The fourth one here is PepsiCo. I think everybody knows Pepsi. The thing that I love about Pepsi is they are so internationally positioned to do well, regardless of what market conditions, whether on a micro and a macro level. Pepsi is so well positioned. They have such an incredible moat when it comes to their business. The fifth one here is going to be Procter & Gamble. Procter & Gamble generates revenue not only here in the United States, but also internationally. Procter & Gamble has amazing brand loyalty. The products that you have, your consumer products, you probably don't even know it, but you're using Procter & Gamble products on a daily basis. The next one here is MPW, the one that we just talked about. I am so bullish on MPW. I think it is one of the best REITs out there with international exposure. The next one here is McDonald's. I don't think you can go to any country and not talk to somebody that doesn't know McDonald's. McDonald's is a technology company, it's a food company, and it is a real estate company. So international, real estate, pricing power, you name it, McDonald's really is one of the best of the best when looking at a higher inflationary time. The next one here is Lockheed Martin. Lockheed Martin has a massive moat. They do operations primarily with the government. They are international here in the United States and abroad. This is a company that I personally believe is on sale today. I think it's a great opportunity. This one is a little bit cyclical because it really does fluctuate with the governments, you know, which party is in power, but overall is a very high quality dividend stock. The next one here is Honeywell. Honeywell is an international company. Its revenue is generated across the globe, so not just here in the United States. And then the last one here is Coca-Cola. Everyone knows Coca-Cola. The brand Coca-Cola is one of the most valuable brands in the world. It's been one of the most valuable brands in the world for decades, and I believe that it will continue to be that. You can't go to any country in the world and ask somebody, you know, do you know what Coca-Cola is? And not have them know what Coca-Cola is. The 10 dividend growth stocks here are just a few examples of those that you can be looking at when you're building out your portfolio. By no means is this portfolio final, right? I'm not saying, hey, take these 10 stocks and only invest into these 10 stocks. I think you need to have a hybrid approach to how you're viewing dividend investing. You have to have a growth component. You have to have a value component. The portfolio has to meet your needs and your goals. And in order for it to meet your goals, you have to know what your goals are. For example, this portfolio has a higher starting yield. But if you have a longer time horizon, it may make more sense to focus a little bit more on growth. Say, for example, you're in your 20s. Maybe you would want to have more exposure to McDonald's and less exposure to Lockheed Martin, for example. So these are just 10 examples of 10 high quality dividend growth stocks that I own, that if you're concerned about inflation, take a look at these companies and really understand how they generate their revenue, where they generate their revenue, what is their competitive advantage, do they have a moat, do they have pricing power? And I promise you, if you understand these things, the topic of inflation will no longer keep you up at night, but in fact, it'll actually get you excited because you know that you're positioned for whatever comes. Thank you so much for watching, everybody. I hope that you learned something new. Don't get scared about inflation. Educate yourself, understand what it means, be prepared, and I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.